be a charity or a church. So if you have, all right, any idea what is the world's largest endowment fund, Tom?
Yes, it's the Gates Foundation.
It is not the Gates Foundation. That's a good guess. Yeah, you can start a candidate. We'll see here. Let's see. Does anyone else have a guess? Largest? Yes, Dan.
Is CalPERS count?
CalPERS is on the list, but it is not the top. Yes, that does count, but it is on the list. All right, it is, in fact, I don't think anyone's going to guess this, the top 4 or 5, though. So number 1, which dwarfs the others significantly, Ensign Peak Advisors, which is the investment arm of the Mormon Church, $124 billion. Ensign Peak Advisors. The 2nd, 3rd, 4th, and 5th, respectively, Japan Science and Technology Agency, number 2, $80.7 billion. That was one I had not heard of. Stanford, $75 billion. Harvard, just shy of $73 billion. Yale, $56 billion. So, Tom, you guys first on this. Do you mind, Dan, unless you really crave 100 grand? Do you want money? You both of you? All right, Tom. 100 grand. All right. Another quick trivia question. I just find this interesting given the interest in cryptocurrency these days and the number of questions we receive about it, though that certainly has died down. Anyone want to take a guess from the years 2013 to 2022, the last 10 years, how many defunct cryptocurrencies there have been that are no longer around? You would have lost all your money had you put anything in it. Who's got a guess how many cryptocurrencies have died over the last decade? 250. Okay, multiply that a little bit, Jack. 250. Any other guesses? We're getting close. Any other guess? I'll give that to Dave because you're close. 1,584 have been abandoned due to no volume. 528 have just been outright scams or have had other issues. 238, the initial coin offering, they call it, like an IPO for stocks, failed or was short-lived. And then 33 were just created as a joke with no purpose and are now defunct. So there are a lot of cryptocurrencies, still the wild, wild west of that. I can throw it, but I'm gonna, just for the sake of everyone's safety, I've got this up here for you. Last one, just another fun one here. Anyone want to take a gander at the magnitude of global wealth? All the household wealth, global wealth as measured by Credit Suisse, not necessarily the best example, but as measured by Credit Suisse as of the end of 2022. Global wealth, just a number, a guess. Countries, households, everything, the global value of assets in the world as of the end of last year. What was that? A whole bunch? That is the technical answer, Katie. Yes, absolutely. That is the technical answer. Anyone want to put a dollar and a cent to that? Otherwise, that's coming to you, Katie. It is a whole bunch. All right, it is a whole bunch. We're looking at, as of the end of 2022, global wealth, $463.6 trillion worth of global wealth. To give you guys an idea, the global value of publicly traded securities, the global equities markets, just shy of $96 trillion as of the end of last year. The debt market, bonds, fixed income, people aren't as excited. The stock market gets all the attention, obviously, when stocks are volatile. Bonds were volatile last year, too, as many of you probably know in here, especially those that are in retirement. But stocks get all the attention, but the bond market globally dwarfs the stock market. $300 trillion as of the end of 2022 compared to just shy of 100 for the stock market. And then the derivatives market, which some of you guys may not be familiar with, but those are options, puts, calls, other derivative securities that derive their value from stocks, bonds, or other securities. That market, the notional value of that globally, $600 trillion. So just some interesting facts there, but Katie, you've got another payday bar, and again, I don't want to injure anyone. Played baseball in my day, but my accuracy might, I don't know these days. It's been a while, so all right. Well, guys, I'm going to skip the whole beginning part here. You're going to hear a lot of me clicking. Unfortunately, the appendix version of this document accompanied me, so all of the additional slides I did not intend to have in here are in here, and we really don't need to go through any of this first part because honestly, we've talked about this already in the bio, and it just talks about our firm a little bit. But again, I will just comment, our practice, we're located in North Canton. Our whole aim is to help clients cut through the noise, simplify the complex, and bring clarity to their financial future. If we do that, we think it's going to provide peace of mind and confidence, which is, ultimately what everyone's after at the end of the day. But ultimately empower our clients to focus on what matters most to them and most to them in life, whether that's their career, their retirement, enjoying time with their grandkids, passions, hobbies, whatever that may be. So I'm proud of our firm and our practice, but again, for the sake of time and because we covered a lot of this in the bio, I'm going to go through it. And again, I did not want this to be a commercial for us, but basically any financially related need that our clients could have, whether it be retirement income planning, estate planning, asset management and investment management, charitable gift planning, you name it, tax efficient strategies. We coordinate a client's complete financial picture through a consultative approach and process. So, all right. What I want to touch on, principles for successful long-term investing. So a lot of these pieces pulled from one of our strategic partners, JP Morgan Asset Management. We've got others, Capital Group, American Funds, of course, Raymond James, who we affiliate with. But we're an independent firm, meaning my partners and I, we're not employees of any particular firm with a corporate mandate or a corporate agenda, product to push. We're completely open architecture consultants and fiduciaries for our clients. So you're going to see pieces from a lot of different asset managers out here that I think convey some important principles for successful long-term investing. Again, whether you're still building wealth, whether we're in wealth consolidation mode and peak earning years just prior to retirement, or if we're in distribution mode. And I know there's a couple others in this room that are in the financial services industry or have been in the financial services industry. Guys, there's nothing groundbreaking or revolutionary here. Hopefully some of you have heard this in one way, shape, or form at some point from an advisor or your own research. So it's not anything that I think is going to knock your socks off, but I think they're important principles to be reminded of. And unfortunately, or maybe fortunately, I should say, being successful financially long term, whatever your goals or objectives may be, it's the answers aren't sexy. The answers are kind of boring a little bit, but again, it's discipline, and we'll talk through that here right now. So some of those principles: plan on living a long time, cash isn't always king, harness the power of dividends and compounding, avoid emotional biases by sticking to a plan, volatility is normal, don't let it derail your progress. Diversification works, staying invested matters. Got a lot of supporting pieces for this. Again, I'm going to click through a lot here, but I do want to point out some slides and principles that I think illustrate it well. Let me zoom out here a little bit. So, guys, thankfully, the path to long-term success does not involve you trying to time the market to have that crystal ball that no one has. I'm still looking for it. I promise I will share it with everyone in this room when I find it. I'm not selfish in that way. I will share it. But ultimately, what I really should have said at the beginning of that 7-point list there is planning drives the process. And our whole process and approach, any of you, your process approach should be focused on your personally meaningful goals and objectives. What are we saving for? What are we investing for? What am I trying to accomplish? That should drive the process. That should drive the plan. And then ultimately the investments support that strategy. And you course correct, revise over time as necessary. But, the things that are out of our control, what the market's going to do one year to the next, who's going to be in office, what economic policy is, tax policy changes that could impact the tax features of various retirement accounts or whatever it may be, what the economy is going to do one year to the next. Those are the things that are out of our control, and thankfully those aren't the things that matter most when it leads to long-term success. Some control, we've got some control over the length of time that we work, assuming, there's not an accident or injury, how long we work, what our employment earnings look like. Some control, not total control, some control. Longevity, taking care of ourselves. I'll talk about longevity in a minute. Total control, thankfully, and the things that matter most are patterns of saving, spending, living within our means, starting early, saving often, how we invest, our asset allocation and where we invest. Those things studies consistently show are responsible for greater than 90% of our return experience as investors over our lifetime. So getting those things critical is what's most important. Some quotes here, I'm not going to read all of these, but Warren Buffett says, I make no attempt to forecast the market. My efforts are devoted to finding undervalued securities, but I really like John Kenneth Galbraith's quote here that the function of economic forecasting is to make astrology look respectable. Right now, there are opinions across the board about when will we see the next recession, not if, When we'll see the next recession, it's been talked about for over a year. It hasn't happened yet. We will see another one. Again, you could find an economic opinion out there to support just, right now about any belief you want to make about the markets and the economy and the trajectory. It's very challenging to do. These slides just support what I said. We structure a portfolio to match an investor's goals in retirement, and that's what supports the plan. Those goals can be from, again, your stable absolute necessities and spending, things that are more variable as far as trips and travel, aspirational things, and then legacy, passing wealth to the next generation. That's important for some clients. Others, it's not a focus, and there's no right or wrong there. So just slides that support that. I told you guys I'd be clicking through a lot. Plan to live a long time. Our base case planning scenarios, I'm sure firms similar, Dave, I don't know, what you guys use as a standard. Dan, you're gonna, be familiar with this, but we're living longer. Gone are the years where it was a 10-year retirement window. We've got clients, and many of you are gonna know people who have spent more time retired than they did working. Pensions are largely a thing of the past unless you work for state or local government or federal government, but more and more of the retirement burden is on our own personal savings and of course the Social Security system. We don't need to get into that. Yes, I get asked all the time, is Social Security going to be there? It's going to be there. Probably going to need to see some changes for folks that are a little bit younger, but it'll be there. But plan on living a long time. Right now, for a couple that reaches age 65, there's a greater than 50% chance that one of those individuals is going to live into their 90s. So we plan 94 women. Hey, the better sex lives longer. 94 for women, 92 for men. I'm not afraid to say that. My wife paid me. I'll go get my my payment later. But yes, so 94 for women. Gosh, that sounded inappropriate. Boy, I didn't mean that. Don't go off the cuff, Connor. Stick to the script. 94 for women, 92 for men. So plan on living a long time. We need our money to last a long time, and that's one of the reasons why, one of the common misconceptions we see is that I need to become very conservative leading into retirement. I can't afford to put up with the volatility that you can see in stocks, when in reality, the vast majority of us are going to need to continue to have some exposure to ownership of companies for the growth potential they provide, also the income they can provide via dividends. The theoretical spending profile, again, I always say in retirement, is you kind of follow retirement smile. This just demonstrates, you have your active phase, or what we say is the go-go years. You've got the slow-go years, which, okay, we settle into retirement. We might not be traveling the world as much or be as active, but we're still doing things. Spending goes down. Then you have the no-go years, which, you hope are few and far between. My dream is to die hitting a three-point jump shot on a basketball court playing, if I'm still able to play. 80s and 90s, that might be a little bit of a stretch, but to just go there. I don't want to be laid up or anything like that. But ultimately, most individuals are going to have a no-go years where healthcare expenditures can become a greater proportion of the plan, hence that smile that you see there. Change in lifestyle, cash account return. So cash not always being king, guys. You look at this chart, and I don't know how easily you can see, but the gray bar reflects what you could have gotten on CDs over various decades, the 80s, 90s, 2000s, 2010, 2020 so far. This is through the end of March, and these are, annualized returns for that decade. But it looks at what you could have gotten on CDs, safe money, basically a proxy for interest rates, and then the other boxes, I'm not sure why the key didn't come through on that, but just are measures of inflation and the various components of inflation. So in the 80s, yeah, cash could keep up with it a little bit. A lot of you remember, double-digit interest rates on not only your savings accounts, but mortgage rates as well, too. I'd say the anomaly was probably the 2.8 to 3.2% mortgage rates we'd seen for the better part of the last several years before March of last year rolled around. But the whole point on this is that, cash does not necessarily provide, what it used to. And ultimately, one of the big risks with being too conservative, holding too much cash, is ultimately its ability or inability to keep pace with inflation. If we see inflation average around 3%, so stocks over the last 100 years, guys, have done about 10% on average. Bonds have done 6%. Inflation's averaged about 3%. So essentially, you think about the impact of that on a 30-year retirement, what cost you, $1 in year one of retirement. 30 years later, this is going to cost, maybe 2.5 times plus that. So we need to be thinking about how is our investment strategy or our streams of income keeping pace with inflation or not keeping pace with inflation if we don't want to be stuck in a situation where we're living on a very fixed income in the future. So cash isn't always king, even as comfortable as it may feel. to just summarize what this slide shows, guys, it is essentially that when cash feels as good as it does right now, how many of you are getting flyers in the mail, 5% CD rates, 4.5% CD rates? It's great. We're talking cash strategies with clients too. It can make a lot of sense for short-term strategic savings, cash that is not designed to be put towards the markets for investment purposes, whatever it may be. But if we're putting money in cash right now because it feels good and it feels safe, consistently we've seen in historical periods when interest rates have peaked over the following 12 months, other types of fixed income conservative investments have outperformed cash as measured by CDs. So that would just be quality bonds, other investments there too. So cash can be a trap if we're doing it for, fear purposes or just because it seems like a safe haven. It isn't always what it's cracked up to be. Important to have some though. The power of compounding, guys, this, easier way to say this, rule of 72, you think about the length of time it takes for your money to double. If you're going to get a 10% rate of return for simplicity's sake on an investment, divide 72 by 10, it's going to take just about 7 years, 7.2 years to see your money double. But the reinvestment of dividends, and especially in a year like last year, or the reinvestment of interest in a portfolio, it's one of the key ways to build wealth as opposed to just price appreciation alone. You think about a down year last year, the silver lining is that the dividends and interest, assuming, for those that are still building wealth or not taking those as income, those are being reinvested presumably into shares of quality companies or quality fixed income issuers at discount prices. So that's when compounding really works for you. No one feels great coming out of a year like last year. Portfolios are down, the stock market's down, the bond market's down, one of the worst years in history, if not the worst year in history for bonds. No one's excited about that, but I always point out the silver lining is it's not that, the 500 largest corporations in America, as measured by the S&P, lost 25% of their value permanently. It's not that the tech stocks, growth stocks lost 30% of their value permanently. No, they're temporarily down on paper, but ultimately, if we have a disciplined strategy, process, approach, and we're using quality managers, it's an opportunity. I'll touch on that in a minute there too. But benefit of saving and investing early. It's incredibly challenging to catch up. And without getting into the weeds on this chart, it just shows someone that started early and even stopped investing versus someone that started 10 years later and invested 3 times the amount. There's, yes, assumptions as far as the rate of return, the time horizon, everything there. But ultimately, the earlier you start, the better off you're going to be. Saving early, saving often, timing the markets, not timing the markets is what matters most. Retirement savings checkpoints. We'll just skip over this. It's a quick and dirty kind of, not even a rule of thumb. I hate rules of thumb because every client's unique, every situation's unique. I get asked all the time, well, what's the exact number I need, or what percentage of my income do I need? It depends. Like most financial questions, ask your advisor. They'll tell you, should I do this? Should I do that? A lot of times the answer is it depends. And I always say this is an industry where you never say never, you never say always either. But a lot of times the answer is it depends. Retirement savings checkpoints. This is a fun exercise to go through, but I'm just going to skip it for the sake of time here. Avoid emotional biases by sticking to a plan. We all have a lot of cognitive biases, home country bias, using past decisions or this is what we'll say all the time, historic performance does not predict or indicate what future results are going to be, or we're comfortable with, the US and we're comfortable with this investment that we made because we knew the company or because we worked there. There's a lot of biases and emotional decisions that can cause us to, cause harm to our own plan, our own investing success. All this shows is that the majority of investors, or at least Americans, have the majority of their wealth concentrated in U.S. companies and U.S. bond issues. And I'm not saying that shouldn't be the preponderance of your exposure to the stock market, to the bond market. But if you look at the percentage of the global marketplace or the publicly traded investment universe outside of the U.S., it's substantial. So to neglect the international markets can be a mistake. So don't let our emotions or how we feel about what's happening overseas or sticking just with what we know cause us to make potentially poor decisions and undermine our long-term success from an investment standpoint. A couple more minutes here. So skipping through this. Guys, how to handle market declines. You don't know if you can see this. Let me zoom in here. I just point out the normalcy of bear markets, market downturns, years like last year. Guys, every year on average, it's normal for the stock market. And again, I would dare to say that any of your portfolios, the S&P 500 is not the appropriate benchmark, because you should all be much more diversified than just the 500 largest companies in the US, which is more so a popularity contest in some ways based off of how that index is structured. But using it, going back the last 70 years of market history, not counting last year because it hasn't been updated yet, we see drops of 5% or more. Industry speak, we call those pullbacks, happen about 3 times per year. 10% or more, industry speak, we call that a correction, happens about once per year. The average correction has been about 14% per year. So despite declines of roughly 14% within the course of a calendar year, the market over the last 50 years, 45 years has been positive about 75% of the time from one year to the next. 15% or more once every 3 years, I just call that a deeper correction. And then a bear market, that classical definition, a drop of 20% or more, happens 1 in every 6 years on average. That being said, markets have never failed to recover and regain prior highs. Let me zoom back out on this again. Sorry for the Zoom guys on this. Markets have never failed to recover, regain prior highs. Bull markets last much longer on average than their corresponding bear markets. Again, there's no guarantee that there could not be a bear market one day where the market does not fully recover, but it's never happened yet. The world always seems like it's coming to an end, never quite does. Hasn't happened yet, but the average bear market lasts about 13 months. Sees a drop peak to trough, so peak for the market to a bottom of around 33% on average. For context, last year, the first trading day of the year was the peak for the S&P 500, bottomed on October 12th, down 25%. It was really just a mild bear market, but what sucked the wind out of a lot of investors, took the breath away when you looked at statements was, wow, bonds were down 14% too. Those are supposed to be the defense in a portfolio. But just your average bear market that we saw last year. Bull markets, they last much longer, 67 months on average. Cumulative total returns of 265%, historically speaking. So a market correction, guys, it's an opportunity. I like the quote here, you make the most of your money in a bear market, you don't just realize it at the time. Skipping this. This just puts visual context to what I showed you about the normalcy of corrections in the market for the S&P 500. For the bond market, last year was a really tough year. I won't get too technical on that because I can geek out about charts and graphs. I like them because I love what I do, but I realize that it's not as interesting to everyone else. So I'm going to skip through all of this, or just different iterations to demonstrate what I just said there. A couple other quotes of some of my favorite quotes here. The impact of being out of the market, guys. Why timing the market is a fool's game and why it's incredibly challenging to do. This illustration, I think, is very powerful. So from January 1st, 2003 to the end of last year, if you put $10,000 into the S&P 500 and you kept it fully invested, think about everything that happened over the last, call it 20 years, tail end of the dot-com bubble bursting, the great financial crisis, the global pandemic, which seems like it was a while ago, but it really wasn't. Last year's bear market, had you stayed fully invested, you would have done about 9.8%, an annualized return, which is pretty close to the market's long-term average. However, had you missed just the 10 best trading days, 10 best days out of that 20-year period, your return would have essentially been cut in half. Not quite, but you would have done 5.6%. 20 best days, you would have been down 2.9%. So, you might think, well, what are the odds that over a 20-year period, I'm out of the market long enough to miss the 10 best days or the 20 best days? I think it's important to note that some of the best trading days congregate around the worst trading days, when volatility is highest, when fear is greatest. Dave knows this, Dan knows this, I'm preaching to the choir here, but 7 of the 10 best days occurred within 2 weeks of the 10 worst days. 6 of the 7 best days occurred after the worst day. So again, you think if you start stringing together, missing some of the best days, you can significantly impact your return. That's why it's better to have a plan. Fear is not a plan. Exiting the market and not having a game plan for getting back in is not a plan. Have a plan, execute on the plan, keep the blinders on. Don't worry what the media is saying one day to the next, what the market's doing one day to the next. Doesn't mean you stick your head in the sand like an ostrich and don't pay attention and try to have an understanding of what's driving things in the short term, but ultimately like a horse running the race. You've got your blinders on, we've got the goal, and we don't want to be driven off course by things that are out of our control that long term aren't going to be the key drivers of our success. All right, 5 minutes here, not even, if I want to open it up for questions, which I doubt anyone's going to have questions from Connor. Just shut up. All right, range of stock market, bond market returns, total blended returns. All this illustrates, guys, is time in the markets, not trying to time the markets is what matters most. I get asked all the time, if I have a lump sum to invest, should I wait until we see a decline? Should I not? There are strategic ways to enter into the market, yes. We can always talk more about that. American Funds does a study, I don't have the piece up here, but they look at this fictitious character called Louis the Loser. He puts in $10,000 a year on the worst trading day of every single year over the last 20 years, and he puts $10,000 in on the best trading day. Worst trading day would have been when the market peaks. Best trading day would have been when the market bottoms. No one has the worst timing in the world. No one has the best timing in the world. But if you did, and you stayed invested, you didn't weave it out, you just invested once per year, well, it doesn't take a rocket scientist to say, well, yeah, if you had perfect timing, you would have done better. Of course, absolutely, but not by as much as you might think. They update this every year. Most recently, I think the best timing scenario did about 10.8% over that period. Worst timing scenario did about 8%. So again, not a make or break scenario, but more often than not, we lose a lot of money sitting on the sidelines thinking, overthinking, should I get in, should I not get in? There's always a reason not to invest. And there's always going to be a new wall of worry that emerges as soon as the markets or our own psyches, mount the current wall of worry. So we got through the debt ceiling crisis, we got through the regional banking crisis, it's only going to be a matter of time before, new headlines start to make way. I call this the quilt chart. You can basically see that there's how incredibly challenging it is to pick the top performer in any given year. I love this chart, but again, I'm looking at time and I don't want to be the butt of jokes for Connor going long on time with everyone else in here. So, but mind you, let me point out fixed income, the far left, 08, this dark blue is bonds. This is what bonds normally do in a year like last year where stocks suffer significant temporary declines. 2022, bonds had one of their worst years in history, down 14%, whether you're looking at high quality bonds or core bonds, really a function of the interest rate environment and what the Federal Reserve underwent to in their efforts to tamp down on 40-year level highs of inflation. Another conversation altogether. Lots of slides that just demonstrate the same point about diversification, why it's important, why it matters. But ultimately, staying invested matters. So I love this chart too. Consumer confidence in the stock market goes back to 1971, University of Michigan. I know, boo the team up north, but University of Michigan does this sentiment survey. They look at 9 different peaks and 8 different bottoms. They're not yet ready to say that the October bottom, which is what this one over here is, that was the bottom for sentiment in this market cycle. But the 9 peaks, the 8 troughs, and they say, okay, when we feel the worst about the markets and the economy versus the best about the markets and the economy, what happens over the next 12 months on average? Well, it's kind of a contrarian viewpoint here. Again, this is no surprise to Dave, to Dan, or most of you in this room, but when we're in the thick of it, it's harder to internalize this. When we feel the best about investing in the markets and the economy and things are going well, returns tend to be the most muted. And the 9 peaks, the following 12-month return for the S&P 500, up just 3.5% on average, versus the bottoms, when we feel the worst, we're up the next 12 months on average 25%, 24.9%. So opportunity is greatest when fear is greatest. The night is darkest always before the dawn. Whatever cliche you want to throw out there tends to be true. I do find it interesting, though, that if you look during the financial crisis where we were at, the low that we saw in October of last year in sentiment was even deeper. There's a lot of commentators that suspect that that's really due to the deep political divisiveness in our country right now, too. But I do find it interesting that the most recent bear market wasn't anywhere close to what we went through in 08, 09. But again, just interesting. Same principles are true for the European markets. Consumer confidence, that's just political affiliation, how we feel. Guys, that pretty much sums it up. But last thing I'll leave you with, this is something called the 62-year scorecard. You think about everything that's happened over the last 62 years. Why do we use that? Because it's still the average retirement age for the vast majority of Americans, because that's the earliest right now that you can access Social Security. If you haven't taken Social Security yet, I'd encourage you to wait and not claim at 62. We can talk about that if you're already claiming it. Oh, well, no, nothing we can do. S&P 500 over the last 62 years, all the wars, all the bear markets, all the political events, all the concerns about Trump's in office, Biden's in office, Nixon's in office, Bush is in office, whatever your political persuasion may be, everything that has happened, we look at what companies have done, what quality American businesses have done over that time frame. The value of American enterprise is up 53 times over the last 62 years. The dividend stream that those businesses pay is up 32 times. The income stream, the earnings that they are paying out to shareholders, up 32 times on average, and the consumer price index as a measure of inflation is up just 10 times. So again, if you think about it, why do I own stocks throughout retirement? Why own stocks for the long run? Not saying bonds aren't an important part of a strategy and plan too, risk management, diversification purposes, but ultimately, I don't think anything different is going to happen over the next 62 years of market history where this doesn't ring true. And ultimately, there's been no better hedge against the devaluation of our money, inflation, currency depreciation, than a broad basket of securities ownership of companies. So I'll leave it there. Sandy, thank you. That's my time. I know I went a minute over, so.
Thank you.
Yes.
Will you?
I will be yes, I will gladly.
Winner.
I will gladly. 219-578 is our daily lotto winner. Who was the brave soul that showed up for Connor's presentation and is rewarded? Brian, all right. Brian is, so. Guys, thank you so much. I was told go ahead, yes.
May I say that the bottom line, Connor, is what you have done for Rotary is amazing.
Well,
thank you.
Thank you very much. I appreciate it, and thank you guys for listening. I was told I had to present as part of this. I knew no one would want to hear it, but I was told I had to present, so hopefully you took something away from it, all right? Thank you, guys.
Absolutely.
Hey, Connor, I have one question.
Yeah, Tom.
As people are finding out, there's been some talk about the US dollar being replaced as a world reserve currency.
Yes.
Can you tell us, in your opinion, is that fact-based? And if it is,
Yeah.
how might that impact all of us?
Well, I won't even attempt to do the disservice of speculating on it, because that would be, there's been times and periods in time where the dollar has not been the world's reserve currency or the dominant currency, but the fact of the matter is there is so much of the global marketplace benchmarked to the US dollar right now. I'm not saying that there could not be a period in time where it does lose its reserve status, but we don't believe that those concerns right now are anything, near term on the horizon, or anything to even be really be considered when it comes to, planning decisions at this point in time. Of course, if that happened, it'd be unprecedented, but I've got a good piece. If you really have an interest in that, I've got a good piece from a commentator I really like that speaks to, yes, it could happen, but why it's incredibly unlikely to happen. And that's not US vanity or American vanity. It's just a fundamental fact of the way the global markets are structured currently. So you're probably talking about the BRICS nations. So we've gotten a lot of questions on that, but we don't see that being a threat to the dollar's dominance right now. So.
Thanks, Connor. You got to pay up here, kiddo.
Oh, yeah, here we go. Let me pay up. All right. Go.
You had some wonderful people that participated.
Oh, yeah, I gave you one. That goes to Dave Hall.
Yeah, Dave. Dave, I would we need to sign up. Add this if you want to, as a possible serving dinner at the camp. Okay, if you want to head that up, that would be fabulous. Don't forget your shoes. Next week, we have Gerald Hartzell, Executive Director of Ohio Alliance for the Arts Education. And nothing else? Okay, folks, have a good afternoon. Hurry, hurry. It looks like it's going to start to rain. Meeting's adjourned. Thank you.